Okay, welcome back to part 2 of 25,000 videos on implications of owning a rental property. Today we're talking about passive activity loss limitations. This is something that many people don't understand or even know exists until it becomes a problem for them. So it's important to address it ahead of time. Basically what it means is, rental properties are passive activities in the eyes of the federal government. Almost always. There's some scenarios where they're not, but most of the time they are. And what that means is you can only deduct losses from passive activities if you have other passive activity income to offset them, or if you're below the modified adjusted gross income threshold of 150,000. So I have a lot of clients that are over that 150,000 in household income, and basically they have a loss on a rental property. You get a bad tenant, you've got to pay for a bunch of repairs or something. And they think, well, that's good because at least I'll get big tax write-offs this year. But that's not always the case, because if you're over that threshold, what ends up happening is, let's say I've got a $10,000 loss on a rental property. If I don't have another rental property to offset that, another passive activity, I'm going to be stuck basically suspending that loss into the future until I have future passive activity income, or until I sell the property. You can also take any suspended losses that you had in the year that you liquidate a property. So if I sell it, I can deduct all that. That can help offset any gains that maybe I have from the sale of the property. But if you don't sell it, then you're stuck with it until you have enough passive activity income. And passive activity income isn't what you would probably think it is. Most people think, oh, I'll just use my dividend income or my capital gain income from my sales of stock to offset that. That's actually not a passive activity in the same way that a rental property is, even though you might think it would be. Usually you can only offset these with other rental property income or income from other, maybe investments in either real estate or other businesses that are passive. You can maybe use some of those to offset it. But this is an important thing to understand from a planning perspective, because if you're going to chunk a bunch of costs into 1 year and think, well, it's going to save me a bunch of money in taxes, make sure that you're not in a situation where it's just going to get suspended, because then you realistically could spread the cost over multiple years and it won't really matter for tax purposes. So you might be hurting yourself, kind of just cash flow wise for no good reason. So an important thing to understand that lots of people don't even know exists. So we will be back with 100,000 more parts of real estate stuff. So stay tuned for that.